Howdy, everybody. Welcome to Liberty Call. Today is Wednesday. Is it Wednesday? Yeah, it's Wednesday, August 23rd, 2023. I hope everybody's having a fantastical day out there in the interwebs. And it's pretty nice here in Colorado. Still a little warm. What's the temperature today? It is up to a balmy 85 degrees here in Larkspur, Colorado. But little clouds. But we are supposed to get some cooling off and some more rain, which I've had enough rain this year. I mean, we've had water in the garage. We had, just we're going to float away out here on the top of this, on the edge of the mountains. So anyways, you didn't come here to talk about rainfall. You came here to talk about or to hear about what happened in the markets today. What's going on in the financial world? Well, I'm glad you're here. I can help you out with that. So if it's your first time watching Liberty Call, thank you very much. If you could give me some thumbs up, like, share, subscribes, follows, slam that notification bell so you know when the hell I go live. Let's go ahead and jump into the numbers for today. All right. Dow Jones was up 0.54%, 184 points, closed at 34,472. S&P 500 was up 1.11%, closed at 4436. NASDAQ up 1.59%, closed at 13,721. The VIX fell 5.83% today. It's currently at 1598. Canada was up 0.96. Brazil was up 1.57. And Mexico was up 0.92. Over in Western Europe, Germany was up 0.15, the UK up 0.68, France flat at up 0.08, Netherlands up 0.34, Spain flat at up 0.02, Italy up 0.24, Switzerland up 0.9, and Portugal flat at up 0.08. Russian exchanges both in the red today, the MOX down 0.57, the RTSI down 0.61. And the overnights in Asia look a little mixed. The Nikkei in Japan was up 0.5%. Australia up 0.38. New Zealand up 0.68. In China, the Shanghai was down 1.34%. The Shenzhen Component down 2.14%. China A50 down 1.14%. DJ Shanghai down 1.53%. Hang Seng was up 0.34%. And was the Taiwan weighted open? Maybe. It says it was up 0.34%. For the 22nd. So it may not have been open. All right. Well, that was all the major indexes of the world. Good stuff. Lots of green. I don't know how long it's going to hold, but my personal expectation is that things are going to get a lot worse. But again, if you've been watching me on a regular basis, you already know that. All right. Market recap. Indexes jump. AI, chip maker, Nvidia up ahead of results. All right. U.S. stocks exhibited a robust surge in Wednesday's afternoon trading, with the S&P 500 and NASDAQ both climbing over 1%. This surge was prominently driven by Nvidia, shares gaining momentum prior to the company's quarterly results announcement. Nvidia's chips, widely used for AI computing, have raised investor expectations for another positive outlook, which could potentially extend the rally in the tech sector. Nvidia shares were up by 2.6% during afternoon trading, building on its recent upward trajectory, including a record high hit the day before. Market sentiment was additionally lifted as the yield on 10-year U.S. Treasury notes subsided from nearly 16-year highs. This adjustment followed weak business activity data from both the United States and the Eurozone. The persistent ascent of long-term rates has been a concern for the market, making investors closely watch the U.S. Federal Reserve Chair Jerome Powell's comments at the Jackson Hole conference scheduled for this Friday. His insights are anticipated to provide clues regarding the future trajectory of the U.S. central bank's interest rates. I bet they keep them higher for longer, and I bet they raise rates by at least another 0.25%. I would bet at the September meeting, but at least, out of the next three meetings, September, October, and December, I think they're going to do at least one. Alrighty. Investors are particularly focused on Nvidia's report and comments, as they are expected to play a crucial role in shaping broader market sentiment. Nvidia is a significant player in the group of mega cap stocks known as the Magnificent Seven, which includes Apple and Tesla. These stocks have been pivotal in driving the S&P 500's substantial gains this year, and there are concerns of a potential market sell-off if Nvidia fails to meet the high expectations. Additionally, shares of drug makers Gilead Sciences and Merck & Co. advanced as Swiss rival Roche accidentally published positive trial data related to a lung cancer drug. On the New York Stock Exchange, advancing issues outpaced declining ones by a ratio of 3.62 to 1, while on the NASDAQ, advancers had a 2.17 to 1 advantage. According to a Reuters poll, investors predict the SP 500 to conclude the year at 44.96, representing a roughly 2.2 increase from the previous close. I don't know about that. My friend Brian Westbury over at First Trust seems to think it's going to be a little lower than that. I'd have to go back and see exactly what his prediction is. All right, next up, new home sales. U.S. new home sales rise in July. Prices fall on annual basis. All right, in July, sales of new single-family homes in the U.S. surged by 4.4% to reach a seasonally adjusted annual rate of 714,000 units. Oh, hang on one second. I got to sneeze. Sorry about that. That's the problem with live TV. Ooh. Whew. Anyways, where were we? We were reading through housing stuff. All right. As 714,000 units, as the acute scarcity of existing homes prompted buyers to turn to new properties. This increase in sales was a positive shift, with the pace of June sales initially reported at 697,000 units being revised to 684,000 units. Economists surveyed by Reuters had predicted a rise to 705,000 units, signifying the growth in demand for new homes. New home sales are an early indicator of the housing market, tracked at the contract signing stage, and though they can vary significantly month to month, they increased by a substantial 31.5% year on year in July, the most significant yearly growth since April of 21. Interestingly, the median price of new homes in July was $436,700, experiencing a 8.7% decline from the previous year. This notable annual price reduction marked the largest drop since April, which witnessed the most considerable decreases in 3 years. The inventory of existing homes remains exceptionally low, primarily due to rising mortgage rates, which discourage homeowners with low rate mortgages from selling. The scarcity has directed potential buyers towards new homes, prompting a surge in new construction activity. Despite the growth in new home sales, the combined rate of both new and existing home sales remains at its lowest since January. Existing home sales, which constitute the majority of the market, have been impacted by factors like high mortgage rates and shortage of properties, which have offset some of the new home sales momentum. Notably, the stability of the overall housing market could be impacted by tepid home sales volume, combined with record-breaking mortgage rates, renewed house price appreciation, and persistent supply shortages. While home prices were initially sensitive to the Federal Reserve's interest rate hikes, they have stabilized after experiencing a recession and are still contributing significantly to overall inflation pressures. Regionally, new home sales saw a striking 47.4% monthly rise in the Midwest, the largest increase since September of 2010. In the West, where prices experienced substantial declines over the past year, new home sales also rose by 21.5%. Conversely, they declined by 2.9% in the Northeast and 6.3% in the densely populated South. In terms of supply, there were 437,000 new homes on the market by the end of July, and a slight increase from 428,000 in June. At July's sales pace, the supply would take 7.3 months to clear, a decrease from June's 7.5 months. All right. So housing market's kind of, not great. Yes, if interest rates were still at, mortgage rates were at, 2.5%, 3%, they'd be flying off the shelves like hotcakes, but prices would also continue to still climb precipitously. All right, last up comes from an article from Zero Hedge titled "Another Downward Revision. BLS confirms U.S. payrolls at least 306,000 lower than previously reported." Let's see what this is all about. The Bureau of Labor Statistics, the BLS, has confirmed what have been suspected for a while. U.S. job U.S. job growth has been considerably weaker than previously reported. The preliminary benchmark revision projection published by the BLS indicates that the number of workers on payrolls will be revised downward by at least 306,000 for the year through March. This revision stems from a comparison between reported non-farm payrolls and employment data from unemployment insurance records. The BLS table shows the preliminary benchmark revisions for major industry sectors in March of 2023. While these revisions are currently calculated only for March of 2023, they will be applied to the entire data series when the final benchmark revision is released. The annual benchmarking process aims for more accurate count of employment by aligning payroll figures with the quarterly census of employment and wages, a more comprehensive data source based on state unemployment insurance tax records that cover nearly all U.S. jobs. The QCEW, through thorough coverage of establishment and workplaces and high response rate, make it a more reliable benchmark than non-farm payroll survey. Although the preliminary downward adjustment was somewhat smaller than anticipated, it is crucial to note that this is only the initial revision. The final revision, incorporated into the data series with the release of the January jobs report in February of 2024, is likely to reveal further downward adjustments. Considering the ongoing trend of the Biden administration's downward revisions, it is expected that around another 300,000 jobs will be removed from the total. This aligns with the cumulative household survey, which remains lower than the establishment survey. This revelation might significantly impact the economic outlook, as the already softened job growth figures could have implications on the Federal Reserve's future decisions. If job numbers continue to decline in early 24, this could lead to a more pronounced response from the Fed, potentially involving further easing measures and quantitative easing efforts. And actually, you can see this was the chart right here that you can see the blue is the original, the green is the revised, and then the red is the final revision. And you can see each month, starting in January, the original and then the final number are quite lower in every case. And we'll be curious to see what the final number is for June when it comes out, but I imagine it'll be lower than the number that came out originally. So not good news if they're always overestimating the numbers that are coming out of these surveys and out of the government statistics. So anyways, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. It's getting darker outside. And like I said, go to dsafinancialgroup.com. All my contact information there if you want to book a meeting, read through all the interesting stuff about myself and my dog. Feel free to do so. And otherwise, I will be back tomorrow. Hope everyone has a fantastical evening. Adios.